Ever wonder how some people seem to get rich off the stock market while others are left struggling to break even? Well, the secret isn't in picking the next big stock. It's about using the right strategies to build wealth over time. Curious how you can do the same? In this video, we're diving into the top 5 stock market strategies for new investors that can help you start investing wisely, even if you're just getting started. Building wealth through the stock market doesn't require insider knowledge or picking hot stocks. It's about consistency, strategy, and smart choices. Whether you're looking to build your retirement fund or grow your savings, these strategies will help you navigate the stock market with confidence. So let's jump right in. 1. Passive index and ETF investing. Let's begin with one of the easiest and most reliable stock market strategies: passive index and ETF investing. This strategy involves investing in an entire index, like the S&P 500, or an international index like the FTSE 100, through a single exchange-traded fund (ETF). Instead of trying to pick individual stocks, you're buying a basket of stocks that represent an entire market. This approach not only gives you diversification but also helps spread the risk across multiple sectors, minimizing the impact if one company fails. Why is this so effective? First, it provides instant diversification, which is key to reducing risk. Rather than betting on a single company, your investment is spread across hundreds of top-performing companies. With ETFs, you're buying into companies from different industries, so even if one sector takes a hit, others might still perform well. ETFs also typically come with lower fees than actively managed funds, which means more of your money stays invested in your portfolio. Another big advantage is that, unlike active fund managers who constantly adjust their strategies, ETFs tend to track the market, which means you can expect more consistent returns over the long term. Historically, markets like the S&P 500 have shown steady growth over time, despite short-term fluctuations. Plus, you don't need to spend hours researching stocks or trying to time the market perfectly. This makes ETF investing ideal for new investors who are just starting out and want to build a diversified portfolio without overcomplicating things. It's worth noting that while ETFs are relatively low risk compared to individual stock picking, you should still consider your risk tolerance before investing. Different ETFs offer different levels of risk, depending on the sector or the companies they invest in. So, make sure to choose one that fits your financial goals and time horizon. 2. Automated dollar cost averaging (DCA). Next up is dollar cost averaging (DCA), which is one of the most straightforward yet effective strategies for beginners. This strategy involves investing a fixed amount of money at regular intervals, no matter what the price of the stock is at the time. Let's say you invest $200 every 2 weeks. The beauty of this approach is that it removes the pressure of timing the market. When you practice DCA, you're buying more shares when the market is down and fewer when the market is up. This naturally lowers the average cost of the stocks you're buying, a process often referred to as buying low and selling high. It also takes away the emotional stress of trying to predict stock prices, making it a great strategy for new investors who might feel overwhelmed by market fluctuations. What makes DCA even more powerful is the compounding effect. When you invest regularly, you not only earn returns on your initial investment, but your returns start earning returns as well. Over time, even small investments can grow into something significant. Imagine that you start with just $100 a month. After a few years, you'll have invested thousands, and your money will be working harder for you than if you tried to time the market. Another perk of DCA is that it's automated. Once you set up your automatic transfers to your investment account, you don't have to think about it. This eliminates the temptation to spend the money elsewhere, ensuring that you're building your wealth consistently. This makes DCA not only an efficient way to invest but also a simple habit to incorporate into your financial routine. 3. Income-focused dividend investing. For those looking to generate regular income from their investments, dividend investing is an excellent strategy. This involves purchasing shares in dividend aristocrats, companies with a long track record of paying dividends to shareholders. These companies typically offer a stable source of income, which can be particularly attractive for new investors who want to earn money while also growing their wealth. Dividend stocks give you the opportunity to reinvest your dividends back into your portfolio, creating a compounding effect. Even if the stock price remains relatively flat, the reinvested dividends can help your holdings grow over time. The more shares you own, the more dividends you'll receive, which means more money to reinvest. What's great about dividend investing is that many of these companies, like Coca-Cola, Procter & Gamble, and Johnson & Johnson, have a history of stability and long-term success. These companies are typically leaders in their industries and have demonstrated their ability to withstand market fluctuations, which reduces the risk for investors. As a beginner, investing in well-established dividend payers gives you more confidence as you build your portfolio. But don't forget that dividend investing isn't just about stock price appreciation. It's about building a steady income stream. You can reinvest your dividends to grow your portfolio or use them as passive income, depending on your needs. Over time, this passive income can supplement your regular earnings, making it an excellent strategy for both wealth building and financial freedom. 4. The barbell approach, growth plus safety. For those who want to balance risk while still participating in the growth of the stock market, the barbell approach is a popular strategy. This strategy involves balancing two extremes: investing in high-growth, high-risk assets like tech stocks or emerging markets, and safe, low-risk assets like short-term treasury ETFs or high-yield bonds. The beauty of this approach is that it allows you to capitalize on growth opportunities like artificial intelligence, healthcare, or green energy, while still protecting your assets with safer investments. By keeping a portion of your portfolio in ultra-safe assets, like government bonds or treasury ETFs, you ensure that your safety net is intact if the market experiences a downturn. The growth portion of your portfolio allows you to benefit from higher returns, but it comes with higher risk. On the other hand, the safe portion helps reduce the volatility of your overall portfolio, providing stability. This strategy is ideal for 2026 as markets continue to be unpredictable, and having a balanced portfolio can help manage both risks and rewards. For new investors, the barbell approach provides a way to participate in market gains without being overly exposed to the ups and downs of high-risk sectors. Over time, as the market grows and new opportunities arise, this balanced approach allows you to stay flexible while still safeguarding your investments. 5. Strategic rebalancing. The final strategy we'll cover today is strategic rebalancing. Once you've built your portfolio, it's important to periodically rebalance it to ensure that it remains aligned with your original investment goals. Over time, some assets will grow faster than others, leading to an imbalance in your portfolio. For example, if your tech stocks have performed exceptionally well, they might now make up a larger portion of your portfolio than originally intended. Rebalancing involves reviewing your portfolio every 6 to 12 months to make sure that your investments still reflect your desired asset allocation. If one sector like tech has grown too large, you can sell a small portion of those shares and reinvest the money in other underperforming sectors. This helps you buy low and sell high, ensuring that your portfolio stays diversified and aligned with your goals. The process of rebalancing also gives you a chance to assess whether your original goals are still relevant. Maybe you've shifted your investment priorities, or maybe a new investment opportunity has come up. Regularly reviewing your portfolio allows you to make adjustments that will help you stay on track toward long-term wealth building. Rebalancing also helps you minimize risk by ensuring that your portfolio remains diversified. Over time, it allows you to capture gains from different sectors while maintaining a level of safety, so your portfolio is always working in your best interest. And there you have it, top 5 stock market strategies for new investors. By implementing these strategies, you'll be well on your way to building a solid foundation for long-term wealth. Remember, investing isn't about quick wins, it's about consistent, smart choices that add up over time. Which strategy are you most excited to start with? Let me know in the comments below. And if you found this video helpful, be sure to like, share, and subscribe for more tips on investing and building wealth. Thanks for watching, and I'll see you in the next video.